In fact, the US government is spending more money that the Fed prints than it collects in taxes. And so we're trying to keep this whole pyramid from collapsing.
This is such a critical time for investors around the world trying to understand what's going on. We've got the US markets, pretty much back to where they were. My question to you first, Peter, is are the markets overvalued?
Well, absolutely. I mean, the US market is a bubble. So it's not just overvalued. The valuations are extreme. So the bear market that's going to follow this bubble when it pops is going to be particularly vicious. The problem is it may be harder to detect the magnitude of the decline if you're measuring it in US dollars. But if you're measuring it, let's say in Australian dollars, that's where you'll see a much bigger decline. Of course, the biggest decline of all will be if you're pricing US stocks in terms of real money, which would be gold. And I would expect to see major US stock markets lose 80 to 90% of their value from here if you price them in gold.
Right. So obviously, understanding where we are is important. Understanding where we come from helps to explain where we may be going. And of course, the Fed has been pumping liquidity in like you wouldn't believe there's any tomorrow, right? And they've been doing it for a long, long time. This isn't just the virus related, is it? There's a structural question as to whether the Fed is actually just blowing the bubble higher.
Yeah, well, providing liquidity is a nice way of saying it. What they're doing is they're creating inflation. They're just inflating. They're monetizing government debt, and they're buying assets with the money that they create out of thin air. And the goal is to prop up those asset prices, but also to enable massive U.S. government spending. In fact, the U.S. government is spending more money that the Fed prints than it collects in taxes. And so we're trying to keep this whole pyramid from collapsing, but eventually, it's going to happen. And the fact that they delay the day of reckoning with this policy just means that when that day arrives, we have a lot more to reckon with, and so it's a much bigger crisis than would have been the case, had we faced the music years ago.
And of course, it's not just the Fed, but central banks around the world are following suit. Here in Australia, the RBA took their rates to 0.1% last week and announced a quantitative easing program. We've got the same going on, of course, in Japan and in the Eurozone and in the UK. So everybody's just going down the same path.
Right, but I think they're following the Fed's lead because everybody is afraid of having normal interest rates because nobody wants their currency to appreciate, which seems counterintuitive because a strong currency is a good thing. It means that your wages have more value, your savings have more value, you can buy more stuff for less money, you have a rising standard of living. But modern day central bankers for some reason have no common sense and they think that weakness is strength. But eventually when consumer prices really start to rise, the public around the world is going to be, protesting the rise in the cost of living. And so interest rates are going to eventually rise, and they're probably going to rise much higher than they ever would have gone had the central banks not gotten so far behind the curve. But the countries that have the most amount of debts are going to be the ones that are least likely or able to raise rates. And so inflation is going to just ravage those economies.
And if I think about that liquidity that's been created, a lot of it's flowed back into the stock markets and into bond purchases and those sorts of things. So it's not necessarily hitting the real economy directly.
Well, it's not only not hitting the economy, it's draining the economy of capital. The reason we don't have real economic growth is because capital is being diverted from Main Street to Wall Street. So if we want real economic growth, we need more savings so that we can have more legitimate capital investment. But we're not going to get more savings until we have higher interest rates. But the Federal Reserve is actually discouraging people from saving, as are central banks around the world. And they're encouraging reckless debt, which just fuels asset bubbles and consumption, all of which undermines real economic growth.
And interestingly here, the Reserve Bank governor several times said people have to move into the market, take market risk if they want any sort of returns.
I know, but first of all, you're distorting the markets by causing all this money to artificially bid up prices. But in the end, the losses are going to be horrific. To say that, well, people have no choice but to take risk, I think they do have a choice. I don't think they have to buy overpriced stocks. Now, fortunately, if you look around the world, there are stocks that are not overpriced. I mean, I find that there is still a lot of value in the markets if you spend the time to look for it. So you can buy companies at reasonable or actually cheap prices now and get good dividend yields. But also, I think gold and silver are still very cheap relative to the amount of fiat currency that's been created. And I think there's a lot of opportunities in the mining sector. I think a lot of these stocks are going to be raising dividends significantly over the years. I think their cash flows are going to improve dramatically as the price of gold rises much faster than the cost of producing it.